Good day, Ma'am Magalona. We are the last representator, the Group 9, and our topic for today is about reversing entries. Reversing entries is a journal made in an accounting period which reverse selected entries made in the immediately preceding period. We have here an example of reversing entries. It shows that an expense accrual in January for an 18,000 expense item for which the supplier's invoice has not yet arrived. Now, we will create the following reversing entry at the beginning of the February accounting period. This leaves the original 18,000 expense in the income statement in January, but now create a negative 18,000 expense in the income statement in February. But we are not done yet. The supplier's income arrives later in February, and we record it with the following entry, which offset the negative 18,000 that would otherwise have appeared in the company's income statement in February. Thus, the result is that the 18,000 expense appears in the company's income statement in January, which is presumably when it was supposed to appear under the accrual basis of accounting, which there is no net recognition of any expense at all in February. Thus, a reversing entry has allowed us to properly record an expense during the period when the expense was incurred, rather than in a later period when the company obtains the supplier's invoice. Accrued expenses. Accrued means to increase or accumulate. When a company accrues expenses, this means that its portion of unpaid bills is increasing. We have examples of accrued expense. First, when a company purchases supplies from a vendor but has not yet received an invoice for the purchase. Other forms of accrued expense includes interest payment of loans, warranties on products, or services received, and taxes. We have also the goods and services consumed but no invoice has been received yet. We have also the wages that are incurred but payments have not yet to be made to employees. In order to understand the accrued expense, it represents a company's obligation to make future cash. They are shown on a company's balance sheet as current liabilities. Lastly, an accrued expense is only an estimate and will likely differ from the supplier's invoice that will arrive at a later date. Next, we have also the accrued income. It is a money that's been earned but has yet to be received under standing. Most companies are accrual accounting. It is an alternative to the cash accounting method and is necessary for companies that sell products and services to customers on credit. In other words, just because money has not yet been received, it does not mean that revenue has not been earned. Both individuals and companies can receive accrued income, although it is not yet in hand. Accrued income is recorded on the books when it is earned, in accordance with the accrual accounting method. Payment of expense and pre-collection of income. Payment of expense, it is a cash payment of a transaction in which a business settles the cost of an expense immediately in cash. We have also the pre-collection definition. Refers to the revenue that not yet been rendered or earned by the company but paid by the customers. Pre-collected or earned revenue is a liability account and not a revenue account, for we haven't yet rendered any services as an engaged for the payments received. We have here the example. On June 2, 2007, Rose Dormitory received a payment from a tenant as an advance payment for the room rental for 10 months worth 50,000 pesos. So, 50,000 divided by 10 months is equals 5,000 per month. And now, let us solve the rent income earned. From June to December is equals to 6 months times 5,000 pesos per month is equals 30,000 earned income ending balance. We have also the unearned income. Let us know. 50,000 minus 30,000 earned income ending balance is equals 20,000 pesos, or we can solve it in other way, like 10,000 minus 6 months equals 4 months times 5,000 is 20,000 pesos. Therefore, in order to illustrate or to split up, there are two approaches that can be used in recording pre-collections upon the date of pre-collection or upon recording the journal entry. As you can see there, we have the income method. Under this method, an income account is credited upon collection of receipt of cash or upon recording the journal entry. This method also called the nominal approach because a revenue account is an income statement account. Second, we have the liability method. Under this method, a liability account is credited upon collection or upon recording the journal entry. This method is also collected real approach, it is called real approach because A liability account is a balance sheet account. For all balance sheet accounts are called real accounts. And that's all for today. Thank you.
Alternative guide in determining what adjusting entries and accrual and deferrals are reserved. All accrued and deferred items adjustment that set up balance sheet accounts are reversed. Since one of the two accounts involved in the adjusting entry is the balance sheet account, determine whether said accounting is in the normal balance. If so, then what adjusting entry must be reserved? To illustrate, using our previous illustration, adjusting entry in accrued expense. Explanation of this is accrued rental expense is the balance sheet account and in is normal balance of a debit being a liability account. This must be reversed. Adjusting entry on refilled expense or expense method. The explanation of this is with the two accounts involved in the adjusting entry. Refilled insurance is a balance sheet account since it is normal balance of the debit. This must be reversed too. Asset method. This is the adjusting entry. The balance sheet account is the repaired insurance being an asset. Since it is credited and not in normal balance, this must not be reversed. Income method. In this adjusting entry, the balance sheet account of unearned rental income being a liability since it is normal balance of the credit, this must be reversed. The last is liability method. You notice that the unearned rental income account, which is balance sheet account being a liability, is divided and not is the normal balance anymore. Therefore, this must not be reversed. And that's all. Thank you for listening, everyone.